In folklore, Robinhood is an outlaw that steals from the rich and gives to the poor. The eponymously named Robinhood, the company, was founded to democratize access to financial markets through commission-free stock trading. But the company suffered a series of scandals, including one of Robinhood's users committing suicide and a record fine from regulators after misrepresenting its users' cash balances. Today, the company is a lightning rod for our socioeconomic divide. Ask two different people, and the company's either a hypocritical fraud serving the hedge fund elite or a savior to the next generation of aspiring investors. In the wake of Robinhood's IPO and tumultuous up and down history, we're going to dig into exactly whether the company is indeed a hero, like its namesake, or something else entirely, and what it says about the future of the company. There's no denying Robinhood is a disruptive company, not just in the generic sense of the word, but in the textbook sense. Harvard professor Clayton Christensen famously defined two forms of disruption.
A disruptive innovation generally has to cause you to go after new markets, people who aren't your customers. And the product that you want to sell them is something that is just so much more affordable and simple. Your current customers can't buy it.
This is exactly what Robinhood has done. Before Robinhood, brokerages charged trading commissions in the $5 to $10 range. If you made, say, $100 trades, this would immediately make that trade highly unprofitable if you started out in the red 5 to 10%. Robinhood offered a simpler product that was free. It was clearly worse in that it didn't have anywhere near the level of customer support or even the most up-to-date information in the app. But for consumers who wanted to trade relatively small amounts, it was a lot cheaper and simpler. And in that way, Robinhood both disrupted the low end of the market and brought in new, younger investors into the market. In fact, as Robinhood states, more than 50% of Robinhood users are first-time investors. It's hard to overstate how impactful that is for the American consumer. As Albert Einstein once said, the most powerful force in the world is compounding, and the greatest compounding asset over the long run is stocks. In fact, if you invested $10,000 in the stock market in 1980, it would be worth almost $1 million today in 2021. But almost half of American households don't even own stock. It's arguably been one of the biggest drivers of increasing economic disparity in the US. When trading platforms charge high commissions, it makes small trades for the masses too expensive. And Robinhood is tackling this problem at an incredible rate and scale. By the time of its IPO, 18 million users have created a funded account. In a single quarter this year, Robinhood grew funded accounts by 5.5 million, or 44%. To put this in context, at the beginning of 2020, Robinhood only had 5.1 million users. Revenue grew 309% year over year to $522 million. Within that, equity revenue grew 322%, and cryptocurrency revenue grew a staggering 1,967%. So Robinhood has also become a very popular on-ramp into crypto investing. As a fun sidebar, Dogecoin alone comprised a full 34% of cryptocurrency revenue and nearly 6% of Robinhood's entire Q1 2021 revenue. Competitors eventually recognized they were going to be disrupted and so were compelled to follow suit and cut commissions. TD Ameritrade, Schwab, and E-Trade all moved to zero commissions, effectively giving back more than $1 billion per year to consumers in the process. So far, so good. But like the mythical Robinhood, the company's had a checkered past with the law. To understand what's at the root of this, we have to understand how Robinhood makes money. If Robinhood's free for users, then how is it a viable business? Well, if you're not paying for it, you're the product. Just like Google makes its search engine free, but then sells user intent to advertisers, Robinhood makes its trading free, but sells the information to market makers. This is called payment for order flow. When a user places an order on Robinhood, the company passes the information about that order to market makers such as Citadel, who can choose to execute the ones they want. They in turn pay Robinhood a small fee for these orders, typically fractions of cents per share. But those pennies add up really quickly. This revenue constituted 81% of Robinhood's revenue, and Robinhood made more than $500 million in 2020 from just 5 firms. Now, this sounds super sketchy and a conflict of interest. After all, hedge funds can just front-run trades, right? Well, there's actually strict laws against this, and it turns out payment for order flow is a natural way for most subscale brokers to get paid for sending orders to these massive institutions that can process the orders more efficiently and cheaper. In fact, this is a fairly common revenue stream in the brokerage world. It's interesting to note Robinhood gets paid more than other brokers per share. Is it because there are market orders from unsophisticated retail investors that can be priced liberally and profitably for the market makers? Or maybe it's just because Robinhood has has the highest share of payment for order flow coming from options, which pay out more per 100 shares than equity trades do. This is all speculation, but what's definitely not good about this whole thing is that Robinhood for years misled consumers about this revenue stream. This was the FAQ page on their website explaining how Robinhood makes money. And as you can see, it had zero mention of payment for order flow until they changed it in 2018. And as the SEC found, training documents for customer service representatives in early 2018 explicitly instructed them to avoid talking about payment for order flow and stated that it was incorrect to identify payment for order flow in response to the question of how Robinhood makes money. Okay, but so what if Robinhood sells your order flow? At the end of the day, all the other brokers do it too, so you're probably still paying similar prices for trades, right? Not entirely. Despite Robinhood advertising their rates beat out other brokers, an SEC inquiry in March of 2019 found that no matter how we cut the data, the percentage orders receiving price improvements lags behind that of other retail brokerages by a wide margin. What's more, the same inquiry found that if orders were large, it would have been better to just use another brokerage with fees. For orders of more than 100 shares, the analysis concluded that Robinhood customers would be better off trading at another broker-dealer because the price per share improvement would likely exceed the $5 per order commission cost savings from trading on Robinhood. That said, Robinhood has been designed for new investors executing smaller trades, so maybe it's still in aggregate a net-net win for its target users. The most challenging part of Robinhood, though, is that it may be designed to monetize unhealthy investing practices. We've already covered that Robinhood makes most of its money selling order flow. To maximize that revenue, you want them to trade as much as possible. In some sense, all the brokerages have this incentive, but Robinhood has taken this to the next level. The company's applied years of Silicon Valley's learnings in gamification and addictive product design to push people to trade as much as possible. Robinhood could feel to users more like a video game or a casino than an investment account, and that can sometimes compel inexperienced investors to take big risks, especially when making trades that involve borrowing money. And there's a large body of research that's found such behavior does not generate optimal investment returns. As an example, Robinhood uses variable rewards and confetti to add a casino-type vibe to the app and make Robinhood more engaging. As another example, Robinhood's product is full of recommendations that create elements of FOMO. Here's a top movers leaderboard. And then of course, if you buy a stock, it will tell you other stocks similar to it. Not a crime in of itself, but certainly encouraging of more trading behavior. Well, what if you don't actually have the money to trade? Robinhood actually gives those users margin to trade on. When you sign up for a Robinhood brokerage account, it may take 2 to 4 days for your money to actually show up in your account. So what does Robinhood do? They give people up to $1,000 in instant deposits even before the original deposit clears. Remember that 81% of Robinhood's revenue comes from payment for order flow? Well, it turns out that of the remainder, most of it comes from interest from investors trading on margin. While Robinhood wants users to trade a lot and on margin, they also want them to trade the highest margin products. Options have a higher payment for order flow relative to shares. So ideally, you want people to trade as many options as possible. Options, though, are risky and dangerous. On Robinhood, you can be approved to trade options within a minute, and it takes up a ton of real estate in the app. Robinhood still doesn't support buying stocks in lots, which would help users on capital gains to be more tax efficient, but they do offer same-day options. And not every user is fully educated about how to trade options. That's compounded by the fact that Robinhood has focused on the presentation and engagement of the information rather than the accuracy. And not only that, but Robinhood's been criticized for not presenting accurate information to traders. Sadly, a 20-year-old committed suicide after seeing an incorrect negative $730,000 balance. And FINRA fined Robinhood a record $70 million for its system-wide outages and misleading communication and trading practices. So now, coming to the famous Gamestop saga. Robinhood was the broker of choice for a lot of people who were buying GameStop stock. During the height of the run-up, they decided to stop allowing people to buy GameStop, which caused the stock to crash, and in some cases even executed sell orders on behalf of traders right at the very low point. So why did this happen? Turns out Robinhood had liquidity issues, in large part driven by the fact that Robinhood's users, of course, trade on margin, which is basically Robinhood's balance sheet, and the fact that a lot of users leverage their positions with options, making it even more volatile. In this case, Robinhood's own tactics of encouraging riskier behavior, including recommending buying fast-rising stocks like GameStop through its top movers, worked against it. And there were no advance warning to users that Robinhood was about to shut down. Add all this up and you get an idea of why even respected investors like Warren Buffett and Charlie Munger have called Robinhood a major problem. Robinhood made IPO history when they reserved an unprecedented 35% of its initial public offering for the trading app's consumers. In a bid to appeal to the little guy, it was initially ironic that the IPO debut was the worst on record for an IPO of its size. But since then, the stock has soared, crashed, and settled in at a reasonable return to its IPO price as of the time of this video. So where does this all leave Robinhood from this point on? Robinhood still has the potential to teach a new generation of investors the fundamentals of financial management, but they've introduced people to risky options trading, trading on loan, trading stocks, and frequent day trading behavior, driven by a business model that monetizes these practices. Since the company has such an incentive to drive more speculative trading from its users, curbing abuse and overreaches will likely have to come from regulation. As a result, the company's IPO and any associated increased regulatory oversight might actually be the best thing that could happen for consumers at large. The legend of the original Robinhood paints a more complex character than the popular hero persona, one in which stealing and robbing may hurt rich and poor alike. As the legend extends to our world of financial access and inclusion, the Sheriff of Nottingham may be a ray of hope that Robinhood's arrow flies straight in giving back to the poor. If you're a fan of giving back, drop a like or comment on the video, and I'll see you next week.